come inside the Bloomberg and take a look at what everyone was illustrating with the rise in volatility here. So the top panel is the overall cross-asset volatility. That's picked up, although still in negative territory. The middle panel is the VIX. Obviously, that has not really picked up that much, but it's around 15, so off what we've normally seen. And then the MOVE index is the last panel, so Treasury volatility. Savita, where do you see the biggest increase in volatility, and is it sustainable?
You know, I think that the volatility, as your prior speaker mentioned, it's normal. This is kind of a normal market environment, and we've just gotten so unused to volatility that this all feels very strange. I think we can expect to remain in a heightened volatility environment for the remainder of the year. The best way to play this market, in my view, and what's been working this year, is picking stocks and picking securities. And, the idea that not everything is going to go up on news and not everything is going to go down on news, but the market is actually starting to differentiate. I mean, what I find remarkable is that this is the best year on record for active managers, for stock pickers. And I think that is emblematic of the fact that the market has gotten a lot messier. So Italy in and of itself, I don't think is as much of a potential hit to the U.S. equity market. If you look at credit spreads in the U.S., they've barely reacted relative to what we've seen Italy, CDS.
Credit spreads, small caps, etc.
Exactly.
But on a broader basis, the world of making decisions on low volatility, that's now changed, and that does have impact on carry trades, it has impact on growth versus value. So paint that picture for us.
So I think, I'm glad you asked. So I think the riskiest area to be right now are the so-called low vol investments. So if you look at the fastest growing trend within ETFs and within passive investments, it's been in these so-called low volatility funds, which are basically a play on interest rates remaining low forever. So, utilities, real estate, telecom, even tobacco stocks have all benefited from the idea that interest rates are going to go to zero and stay at zero for the foreseeable future. And I see that as the bubble in the investment landscape. The idea that investors have basically been piling into the most bond-like stocks as the sort of safe havens. And in an environment where interest rates start to rise, and we're seeing this in Italy, so far in the US, we've seen treasury yields depressed. But if they actually do anything besides go down, I think that's the riskiest area for investors within the equity landscape.